Welcome to Stock Talk. We're jumping straight into it today with a deep dive on Super Microcomputer, that's ticker SMCI, and their Q3 2025 financials. Our goal here is simple. Pull out the really important stuff from their latest earnings release so you get a clear picture of how they're doing and what might be next.
Yeah, what's the story behind the numbers?
Exactly. And hey, if you find this useful, please think about sharing it. Maybe give us a like or subscribe for more breakdowns like this one.
Absolutely. So Supermicro's Q3 fiscal 25. Let's start at the top line. What's the big picture on performance?
Okay, so the big picture is, well, it's a bit mixed, actually. On one hand, you've got really solid year-over-year growth. Net sales hit $4.60 billion.
And that's up, what, about 19.4% from Q3 last year?
Yeah, nearly 20% up year-over-year, which sounds great. But the flip side is that compared to just last quarter, Q2, sales were actually down.
Down by 19.0%.
Okay, quite a sequential dip.
And did management talk about why? Why that drop from Q2?
They did. They pointed mainly to customer delays. Apparently, some customers were taking longer to finalize their platform decisions.
Right. Platform decisions. That makes sense in this space. So they're basically saying the business is there, it's just pushed out a bit.
That seems to be the message. They sounded pretty optimistic that those decisions will actually land in the current quarter ending in June and also the next one ending in September.
Okay, so keep an eye on that. Year-over-year growth, positive, but some near-term friction from these delays. Got it.
Exactly. Now, let's shift gears a bit and talk profitability, because this is where things get maybe a little more concerning.
Yeah, the margin story. I saw that. The gross profit margin really tightened up.
It really did. Came in at 9.6% for Q3.
Which, for context, you need to compare to where it was. It was 11.8% just the quarter before.
Right. And even more starkly, 15.5% in the same quarter last year.
Wow. Okay, so that's a drop of almost 6 full percentage points year over year, 5.9 points to be precise.
That's a big move downwards. What's driving that kind of pressure, do you think?
Well, the report suggests a few likely culprits. First, probably increased competition. You know, the AI server market is hot, lots of players.
So maybe they had to price more aggressively to win deals?
Could be. Or maybe higher component costs are eating into the margin. That's often a factor.
Yeah.
And potentially, just the mix of products they sold during the quarter might have shifted towards lower margin items.
Okay, so a combination of factors squeezing them there.
Seems likely.
And I imagine that pressure on gross margin flows down the income statement.
Oh, absolutely. You see it clearly in the operating income. That fell to $147 million.
Which is down how much?
Down a hefty 61.2% compared to Q3 last year.
Ouch.
Yeah. And it's not just the lower gross margin. Their operating expenses, things like R&D and sales, they actually went up quite a bit too.
How much?
Up 34.0% year over year. So lower gross profit coming in and higher operating costs going out.
Not a great combination for operating income, clearly. And I guess net income followed suit.
It did, unfortunately. Net income landed at $109 million for the quarter.
And comparing that.
Well, it's down significantly, 73.0% lower than the $402 million they posted in Q3 of 24.
Wow.
And it's also down 66.0% sequentially from Q2's $321 million. So, yeah, a big drop, however you slice it.
Okay. So for listeners tracking earnings per share, the EPS figures obviously reflect that too.
Correct. The diluted EPS came in at $0.17.
17 cents compared to
the $0.66 in the same quarter last year and Sifney on Frontage just last quarter. So down about 74% year over year on a GAAP basis.
Got it. Did they provide a non-GAAP number as well? Sometimes companies do that to adjust for certain items.
They did, yeah. The non-GAAP EPS was 31 cents, still down year over year, but it gives another perspective analysts often look at, trying to see the underlying operational performance.
Okay, so summarizing the profitability picture, definitely some real headwinds in Q3. Margins compressed, operating income down, net income down significantly.
That's the story on the profit side, yes. But it's important to say it wasn't all negative. There were some definite bright spots elsewhere in the report.
Right, let's pivot to those. Where does things look better?
Cash flow and the balance sheet, actually. That side of the house looks quite healthy.
Oh. Tell me more.
Well, first off, they generated a really strong $627 million in cash flow from operations just in Q3.
$627 million.
Yeah.
Okay, that's pretty substantial. That gives them flexibility.
Exactly. And at the same time, their capital expenditures, spending on factories and equipment, were quite low. Only $33 million in the quarter.
Efficient capital use then.
Seems that way. And all that cash generation helped boost their cash balance. They ended the quarter, March 31st, with $2.54 billion in cash and equivalents.
Okay, a nice cushion. How does that stack up against their debt?
Pretty well, actually. Total debt was around $2.49 billion. So they're almost in a net cash neutral position. Basically, their cash almost covers their entire debt load. That points to, good financial stability.
That's definitely a positive. Anything else on the balance sheet front? Inventory.
Yeah, inventory levels actually decreased. They were down to $3.87 billion at the end of March, compared to $4.33 billion back at the end of June 2024.
So, suggesting maybe better inventory management, not tying up as much cash there.
Could be, yeah.
Yeah.
Seems like progress on that front. And maybe one more point on cash flow, looking slightly longer term.
Okay.
For the first 9 months of their fiscal year, so ending March 31st, they generated $796 million in cash from operations.
Right.
Now, compare that to the same 9 months last year. Back then, they actually used $1.84 billion in cash for operations.
Wow, that's a huge swing from using almost $2 billion to generating almost $800 million.
Exactly. A really significant turnaround. Highlights, I think, some improvements in how efficiently they're running the core business despite the recent margin pressure.
Okay, so that's a really important counterpoint. Profitability challenges, yes, but cash generation and balance sheet strength look like real assets for them right now.
I think that's a fair assessment.
So let's talk about strategy then. What are they focusing on to navigate this and drive future growth?
Well, no surprise. They're still heavily focused on AI and data center infrastructure. That's their bread and butter.
Makes sense.
The report highlights a few key initiatives. One is continued progress with their data center building blocks solution, DCBBS they call it.
Building blocks, so like modular data center components.
Pretty much. Think Legos for data centers. It allows for more flexible and scalable deployments, which customers increasingly want.
Okay, that sounds smart. What else?
Advancements in their liquid cooling tech. They call it Direct Liquid Cooled 2, or DLC.
Cooling is huge for AI, right? Those chips run hot.
Incredibly important. As AI workloads get denser and use more power, managing the heat is critical. So their DLC tech aims to tackle that efficiently.
So staying ahead on the thermal management curve.
Exactly. And of course, they're continuing to invest heavily in just building AI-optimized servers, making sure they support the latest GPUs and accelerators.
Standard blocking and tackling for them, I suppose.
Right. Plus, they mentioned expanding their global manufacturing capacity, presumably to meet expected demand, and also making some corporate governance enhancements.
Okay, seems like they're investing across the board. Products, capacity, even how the company is run. How's the CEO sounding? Confident.
Yeah, the CEO, Charles Liang, expressed confidence. He highlighted those building blocks, the liquid cooling, their AI leadership, and he specifically reiterated that he expects those customer delays we talked about earlier.
The platform decisions.
Right. He expects those to largely resolve in the June and September quarters, which should drive revenue back up.
So pinning hopes on that Q4 and Q1 recovery based on delayed deals closing.
Seems to be a key part of the near-term outlook. They also mentioned strengthening their leadership team recently.
Oh, how so?
New board members, a new general counsel, a new chief accounting officer. Looks like they're building out the management structure, perhaps for more scale or, enhanced governance.
Makes sense. And their overall goal remains the same.
Yep. To be a total IT solution provider across AI, cloud, storage, and 5G edge. That's the big vision.
All right, so putting it all together, what does the actual forward-looking guidance look like? What are they projecting?
Okay, for the next quarter, their fiscal Q4 ending in June, they're forecasting a pretty significant rebound.
Oh, yeah. What kind of numbers?
Net sales expected between $5.6 billion and $6.4 billion.
Okay, wait. Compared to the $4.6 billion they just did, that's a big jump sequentially.
It is a very significant sequential increase baked into that Q4 forecast. They also gave EPS guidance for Q4 GAAP expected at $30 to $30 per share and non-GAAP at $0.40 to $30.50.
But I guess that strong Q4 forecast really depends on those delayed customer deals actually coming through as expected.
Absolutely. That seems to be the critical assumption underpinning that optimistic Q4 outlook. If those delays persist, well, hitting that range could be tough.
Right. Now, what about the full year? Did they update their guidance for the entire fiscal year 2025?
They did. And this is where you see a bit more caution tempering the Q4 optimism. They actually lowered their full-year revenue guidance.
Oh, lowered it from what to what?
The new range is $21.8 billion to $22.6 billion. Previously, they were guiding for $23.5 billion to $25 billion.
Okay, so quite a reduction in the full-year expectation, even with the projected Q4 bounce back.
Exactly. So Q4 looks strong if the delays resolve, but the overall picture for the full fiscal year is now expected to be a bit softer than they previously thought.
And that likely reflects the Q3 challenges we discussed, plus maybe some ongoing uncertainty, potential economic factors, tariffs maybe.
Yeah, all of the above probably factored into that revised full year number, acknowledging the recent headwinds and maybe just being a bit more cautious overall.
Got it. So finally, did the company explicitly lay out what they see as their main opportunities and risks going forward?
They did touch on that, yeah. On the opportunity side, it's pretty clear. The massive expansion of the AI market is number one.
Tailwinds from AI demand.
Definitely. Then, obviously, getting those platform delays resolved, they also point to their tech leadership in things like the building blocks, DCBBS, and liquid cooling.
Their strong balance sheet we talked about.
Yep, that's an opportunity or at least a strength. And they mentioned the improved governance as well.
Okay. And on the flip side, the risks, what are they worried about?
Well, the risk that those customer delays don't resolve quickly or more pop up, that's clearly top of mind.
Makes sense.
Continued pressure on gross margins is another big one. Can they maintain profitability in a competitive market? Broader economic uncertainty potentially hitting customer IT spending. The impact of tariffs is still a factor they mention. And just the execution risks involved in rapidly expanding their manufacturing globally.
Right. Scaling up always has challenges.
Always.
Okay, so let's try to wrap this up. If we're summarizing this deep dive into Supermicro's Q3,
I'd say it's definitely a complex picture right now. You've got that solid year-over-year revenue growth, which is positive.
but countered by the sequential decline and, more significantly, that real pressure on profitability margins, operating income, net income, all taking a hit in Q3.
Right. Big challenges there. However, you contrast that with their really strong cash generation and a very healthy balance sheet, which gives them resilience.
And they are forecasting a big rebound next quarter, Q4, but that seems very dependent on resolving those customer delays.
Highly dependent, yes. And while Q4 looks potentially strong, they did lower the full-year outlook, signaling some caution.
But strategically, they're still laser-focused on that huge opportunity in AI infrastructure, leveraging their tech like liquid cooling and the building block approach.
That's the long-term play, absolutely, riding that AI wave.
So it really leads to the final thought we want to leave you, the listener, with today. Considering these mixed Q3 results, the margin pressures, but also the strong balance sheet and the anticipated recovery, what factors do you think will be the most crucial for Supermicro's sustained success over the long haul, especially within that incredibly competitive AI landscape?
Yeah, what will really differentiate them and drive value long-term? Something to ponder.
Definitely something to think about. Thanks for joining us for this deep dive on Supermicro Computer.